people suddenly go, oh, well, my money market rate is starting to decline. Let's go ahead and lock in 1 or 2 year treasuries or CDs or whatever for very low risk money. You may have missed the boat because a lot of institutions or other buyers have already gone into that space, bid the price up on those bonds, and push the yields down.
I was going to mention one more thing. If I've got the ability, I'm going to try to pull that chart back up that we just had on the forecast rates. Because one thing I want to mention, kind of tie it back into investments. I know for many of us, a very large investment that a lot of our clients have on the books is going to be money market. A lot of clients like the peace of mind, and the interest rates have not paid anywhere near this in 15 plus years. And so I get it. But the one thing that I'd like clients to kind of be aware of is that if the chart you see right now on your screen, and if you're just listening, the forecast is that rates would go lower if the government cuts rates. If that were to happen, then there's a very strong likelihood that the rate on your money market fund would pay less over time as well. And so dependent upon your individual situation, but a conversation that we would have with you would be dependent upon that. If you are enjoying 4%, 4.5%, it might make sense for your situation to lock that in for a longer term, meaning like via a treasury or something like that. I mean, everyone's situation is different, but if this trend holds, then this idea that you were going to get 4.5 to 5% in cash and money market and just kind of ride that off into the sunset, that may get adjusted if rates move.
Yeah, for sure. And so Treasury is a sweet spot right now. Basically, you can get about 5.1% at 6, 9, and 12 months. So that's the high point of the yield curve. And just to show again how dynamic this is and how much has changed, Jason mentioned money market is a daily number that moves based on current rates. But in January 22, the average money market was paying 7 basis points. That's 0.07%. So that's what you were getting just a year ago. And now we're at 457 versus I think 388 was the last time we did the roundtable. I think we were at 388 on Schwab's money market, and we're at 457 now. But just from a year ago, 7 basis points, crazy.
And that shows both ways, right? So if we talked about how we've benefited from the raising of rates, and that's transpired into higher interest rates on our money market, our CDs, our treasuries, that at some point when that curve does flatten and start to come down, those rates will come down that you're receiving as well. So I think that's what Jason's hitting at, as far as that if there's money, or for clients that, depending on your situation, that have money on the sidelines that plan on leaving it for an extended period of time, if you're comfortable with that rate, it may make sense to make it a little bit more permanent versus the fluctuation of the money market. So
one more quick follow-up before moving on from that, because a very common answer is, well, I mean, if rates are going to go up a couple more times, then why don't I just wait for that and then do something? And then my response is, the fact that we're telling it to you right now on a podcast, we know it, everybody knows it, everybody is playing with the same information right now. And so the market has already moved to it. And so what would cause the market to move differently from what you saw on your chart would be for the government to react differently than what they have already said and what we already believe they're going to do. So if the government raises 1/4 point here next month, what you saw on your chart will probably move very little at all, because the cake is already baked. That price is already set in. So waiting in that sense is not really going to behoove you unless rates go up more. The other thought there is that, I've talked to clients who are like, okay, well, I'm going to stay in money market until rates start going down, then I'll lock it into a longer term bond at that point. The risk there, now granted, rates could always keep going up, but the risk there is that if we wait until that point, then the rates that treasuries are paying now for 6, 9, and 12 months aren't going to be 5 anymore. They could very well be 4.5 or 4 or 3.75 or whatever. And that's if we catch inflation. Obviously it could go both ways, but I just kind of want to explain the relationship there.
Yeah. And just to touch a little bit on what you were talking about earlier, Jason, with what the Fed actually controls. The further you get away from 30 or 90-day rates, the closer you get to 5, 10, 30-year rates, the less control the Fed has over that. So they don't really, for the most part, they don't really play in the 10 or 30-year bond space. And so that just becomes a function of supply and demand. So like you mentioned, if people suddenly go, oh, well, my money market rate is starting to decline, let's go ahead and lock in 1 or 2 year treasuries or CDs or whatever for very low risk money, you may have missed the boat because a lot of institutions or other buyers have already gone into that space, bid the price up on those bonds and push the yields down. So you, to your point, you can kind of miss that if you're playing that game too closely. And there's a big difference between, I think, folks that want to keep money in a daily liquid money market versus locking it up for 2, 3, 5 years. And holding a specific rate over that time. For investment portfolios, for long run investment portfolios, we typically have money, truly invested and not just sitting in a daily liquid money fund. But
100%.
it's been a big uptick for people that do want, and everybody needs to have some safe money, right? And that's money market or treasuries or CDs. And like Kyle mentioned earlier, it's nice to be able to tell them they're actually getting paid to hold that money now. Those are suddenly they're large payments that come into to folks' accounts on a monthly basis for money market distributions.
And I think we say this on every roundtable, but just to follow on to what Jason was saying, for every client that has a question that starts, why don't I just wait until and then whatever after that, markets are a leading indicator. You just can't wait until it happens and then think that you're right at the forefront. You're already well behind. So why don't I just wait until, rates top out, because things have already adjusted before then. So it's a difficult concept to understand, but, markets have already priced in a lot of the information that they expect to happen in the future. And the only thing that really changes that is new information that changes those expectations.
Yeah.
Well,
and that goes back to what Jason said too, as far as everybody's situation is different. And so anything we're saying here is we're not telling you to go out and lock all your money up for a long period of time. It's reach out to us, talk to us, have a conversation, figure out what makes sense for different pockets or, pools of your money, and come up with the right solution for you and your situation, because everyone's unique.
Well, do you remember a couple of sessions ago, we were talking about I bonds and the rush to buy those at 9.62. That was the big number.
Yeah.
I just looked 6.89. So for new buyers there, the market's already paying you quite a bit less. That's a pretty big haircut from 962 to 689. So, and that'll continue. I would expect that to come down dramatically the next 6-month period that pops up.
For sure.
It just won't be as attractive. So
we
talked about inflation enough.
Yeah. I think we killed. Although, listen, it's the one thing everyone wants to talk about, and it's the main thing driving the market.